You spend decades building hundreds of thousands of dollars in equity, but when you retire, that wealth is trapped inside your walls, while your fixed income stays the same. The financial squeeze is often sudden. Rapid inflation and unexpected medical bills can quickly overwhelm a budget that worked just a few years ago. This comparison shows the massive disparity in a typical retiree's net worth. A massive column of tied-up home equity sits alongside a tiny sliver of accessible, liquid savings. This severe imbalance makes seniors a primary target for aggressive financial marketing, promising to convert that home value into liquid cash. Surviving retirement today often forces a difficult choice, whether to begin liquidating the very home you intended to stay in. Lenders like Smart Loan Partner pitch a specific solution, converting that equity into cash that you can receive tax-free. The marketed benefits are designed to be highly appealing. You make zero monthly mortgage payments, and you retain the right to age in place. These loans provide access to substantial capital, with FHA limits currently set at over $1.2 million. But the central question remains, is this a necessary lifeline for your stability, or a path toward eroding your family's wealth? Marketing materials often focus on the emotional relief of the payout, which can obscure the reality of taking on a specialized and complex debt burden. We need to strip away the promotional language and look at the raw mathematics that drive these loans over the long term. A reverse mortgage is an equity liquidation tool. Trading it as a debt product rather than a windfall changes the entire framework for how we must evaluate its use. To qualify, you must be at least 60 years old and hold a significant amount of equity in your primary residence. You can choose to receive the funds as a large lump sum or as a steady monthly income to support your lifestyle. This projection shows the central trade-off. Unpaid interest is added to the principal, causing the loan balance to grow at an accelerating rate. As debt compounds over 15 years, the remaining equity left for your heirs or future care is steadily consumed. While the marketing promises peace of mind, the mathematical reality involves living beneath a debt that compounds every single month. Because of how that interest builds, every dollar borrowed today costs substantially more in the future, effectively pushing the highest cost of the loan to the very end of your life. Lenders suggest using these funds for pressing medical debt, essential home renovations, or travel and leisure. This chart separates responsible uses from risky ones based on necessity. Survival costs like medical bills sit top left, a valid equity trade-off. Strategic renovations sit slightly lower. Conversely, discretionary travel falls bottom right. Leveraging compounding debt for luxuries rapidly destroys your long-term net worth. A lender might imply all spending is equal, but compounding consequences for your future self are much harsher when money goes toward non-essentials. Even the monthly income option is a variable. Its value depends entirely on whether your baseline retirement needs are already met by other sources. A reverse mortgage is a powerful defensive tool for survival, but it is an incredibly destructive offensive tool for luxury. The loan eventually reaches its conclusion when you finally leave the home. This creates a significant trade-off. If declining health eventually forces a move to assisted living, the sale of a heavily leveraged home will yield very little cash for that care. The benefit of having no monthly payments is also temporary. That burden is effectively shifted to your heirs, who must settle the complex debt once you are gone. For family members acting as advisors, it's important to realize that a future inheritance is the literal currency paying for a parent's current stability. The cost of a reverse mortgage is measured in the permanent sacrifice of legacy and end-of-life optionality, rather than in monthly cash installments. These two profiles summarize the characteristics of the ideal candidate versus those who should likely avoid this product. The green light profile is a cash-poor senior who is determined to age in place and must prioritize immediate stability over leaving a financial legacy. The red light profile includes those looking to fund luxuries, or those planning to move within 5 years, or those whose primary goal is transferring a family asset to the next generation. If you fit the optimal profile, your next step is a consultation with an independent fiduciary financial advisor before responding to any loan marketing. Home equity is a finite resource. It must be deployed based on strict mathematical necessity rather than emotional appeals.